The airline industry worldwide is counting the cost of rising oil prices. It says that for every dollar the price of fuel increases, costs rise by more than $1.5 billion. And with prices expected to stay at the new elevated levels, the impact will be felt across the globe. Helen Brown reports.
The fuel bill is coming in for the aviation industry, and it's a nasty one.
I mean, really, $2 billion more, one hit. The price of fuel has gone up double in 12 months. Any company would have to make some adjustments.
Australia's Qantas Airline is a survivor in a tough industry. Like many others, the world's 10th biggest carrier is making decisions it hopes will keep it a success, cutting jobs, dropping routes and retiring and grounding planes. Andrew Miller is a former Chief Operating Officer for Air New Zealand. He advises air companies around the world and says only the smartest will survive.
Well, it is dire for the airlines who have not been making money when fuel was $100 a barrel. That is not going to improve. But the best run airlines will continue to be well run and will come out at the other end of the tunnel with lessened competition, obviously.
Already more than 20 airlines have folded or filed for bankruptcy, and it's predicted more will find themselves pushed too far into the red.
Not only are airlines facing a shock in fuel costs up, over 20%. They're also facing markets that are markedly weaker, particularly in North America, which is close to recession, and it's very difficult to pass those costs on to passengers in that sort of environment.
The International Air Transport Association represents around 94% of global air travel. It's chopped almost $7 billion from its estimate of industry profits for this year and says its members are now likely to lose between $2 to $3 billion.
Well, Airlines were among the first in the world to start having their credit lines pulled for fuel purchases. Prior to 9/11, the airline industry had about a $5 billion line of credit to purchase fuel. Now they're being asked to pay for their fuel in advance.
It wasn't that long ago a barrel of crude oil was around $56. Airlines could make a profit and customers were keen to take up the cheaper fares. But when a barrel of oil hit $130 in May, a frightening new reality set in.
We just have to run the business how we find the impulse on a given month. It's now 35% for fuel. If it became 40%, obviously everything in this country and around the world would change.
Chris Nelder is an investment analyst and alternative energy advocate.
We have not prepared adequately for this day. We do not have alternatives available to us that can make up the shortfall that we anticipate from the decline of the world's mature oil fields. There are a number of alternatives. I think we're going to exploit them the best that we can. But I do not believe that they will be adequate to make up that shortfall once we have officially passed the peak of global oil production.
Some carriers have used hedging to shield themselves by locking in prices by buying a significant portion of fuel well ahead of time. But as jet fuel prices have gone up, that strategy is not as useful. So airlines are playing with their other options. Fuel surcharges are increasing, fares are going up, baggage is becoming even more of a liability, with American Airlines becoming the first to charge for any piece of checked baggage. Significant change is on the way.
Obviously this is long-term sustainable high prices that will pervade the market for a long period of time, and we don't see prices coming back down again. But the strongest will survive. The weakest will not survive.
The International Association says governments can help by allowing greater foreign ownership and mergers and opening up routes to true competition.
It's still a very outdated regulatory system. It would make it much easier for the airline industry and the airlines to rationalise and offer a very efficient service if they had the freedom to operate as free private companies, and at the moment they can't.
Airports too can expect to feel the pain. The credit rating agency Standard & Poor's says the stellar run is over and international airports will have to adapt to a slower rate of growth as more people decide that air travel is simply too expensive. The report also found, though, that most airports are well placed to manage a financial storm, except those in America.